right. Good afternoon, everyone. Happy Friday, and welcome to Business Basics Friday. Welcome, welcome. If you're joining us live, feel free to throw where you're coming from in the comments below. I'm here in New York, and it is 52 degrees today, so um, we're having a warm weather, I guess you could say right now. So Business Basics Friday is a weekly session that we have dedicated to providing value to small business owners by, having different guest speakers. And as far as my background, I'm Safietou Russell, founder and CEO of SDR Consulting Inc. We are a virtual firm based in New York, but we work with clients all over, and we mostly work with business startups as well as helping with business cleanups for those that have made a mess, and also tax resolution services. And so today we are fortunate to have our guest speaker, Timalyn. I've been practicing her name, Timalyn Bowens, and she's going to be covering a very important topic, especially this time of year, where we want to make sure that you're, in line for tax season. So 5 common tax mistakes that entrepreneurs make. Ms. Timalyn, I'm definitely looking forward to hearing from you, and you can take it away. Thanks.
Thank you so much for the introduction and having me on the show today. I can most definitely relate, when you are talking to people on social media and you don't have to actually say their name out loud. When you do, it's like, how do I say their name? So you said it perfectly. My name is Timalyn Bowens, and I also am an enrolled agent. I am not located in New York. I'm located in Louisville, Kentucky. And today we are having very similar weather. I live near an elementary school, and I've been able to hear the children outside laughing and playing. So enjoying this 50-degree weather while we can. In my practice, Bowens Tax Solutions, we focus primarily on tax resolution. So as Safi said earlier, I want to make sure that I'm giving you information that's going to help you be ready for this tax season and actually avoid any issues with the IRS. So we have the 5 common mistakes that entrepreneurs make. And the very first one is thinking they don't have a business if they don't have an LLC. Now, there's a lot of misinformation going around on the internet that says, you have to have an LLC to be able to write things off. Well, the IRS didn't make that rule. If you net $400, which means if you are earning money and after expenses, you've made at least $400, the IRS is expecting you to report that. The IRS wants to know about every red cent that you make. And what I see with entrepreneurs, and this includes freelancers as well, is because they don't have an actual LLC, they don't report the income. And for the IRS, that's a huge no-no. So let me give you an example. Let's say we have a freelance photographer, amazing at what they do. It's something that they realize they could make money doing. So they do all of these photography projects throughout the year. Well, because they don't think they have a business, because they don't have a formal structure such as an LLC, partnership, or corporation, they don't track expenses or income. And I've even had this conversation specifically with a freelance photographer. What happens is we're talking, and because we're connected on social media, so social media can tell on you too, I ask about photography income. And the response I got, and I get from others as well, is, well, I don't have a business, so I'm not going to worry about that. Red flag. If you are earning money and somebody tells you that you do not have to report it, that is not who you want to take your tax and accounting advice from. So as I mentioned, in the eyes of the IRS, as soon as you have that first 400, they are expecting you to report that. Now, it would just be an additional schedule, which we call Schedule C, on your 1040, but they want to know about the business income that you made, as well as the business expenses. What you don't want to happen is you go years without reporting this income, And then you get that letter from the IRS saying, hey, we know you made this money, but you haven't reported it. Because ignorance of the law in that situation is not going to be, oh, I lost my, it's not going to be a good defense. If you made the money, you need to be paying taxes on it, especially if you were earning it. Now, I have some people that say, well, I don't have a business because, I just do this on the side. If you are doing something because you want to earn income from it, again, in the IRS eyes, you have a sole proprietorship, which is a business. So number one, thinking that you don't have a business if you don't have an LLC, that is a myth. If you were earning money, you have a business as far as the IRS is concerned. So number two, not understanding the tax filing obligations for your entity type. So as I mentioned before, if you don't have an LLC, but you're earning money, you're seen as a sole proprietor. With your 1040 on a Schedule C. But a mistake that I see entrepreneurs make, they form the LLC and it's a single member LLC. So only one person is on the paperwork. Well, they will come to me and say, hey, can you file my business taxes? I already took care of the personal. And I'm like, oh no. Single members report their income and expenses with their personal return on that Schedule C, as I mentioned. So from not doing research or consulting with a reputable tax professional, what happens is the entrepreneur will file a 1040, but then they have to go back and file an amendment to add that Schedule C income. Now, another thing that I see often with not understanding the tax filing obligation is I will have multiple people join together and they will form a business. And when they do that, they do it under the umbrella of an LLC. They don't realize that in the eyes of the IRS, now you have a partnership. Partnership tax obligations are completely different from an individual's tax filing obligations. For example, partnerships are due March 15th, not April 15th. So what happens with that, I've seen entrepreneurs not realize they need to file a partnership return, which is a form 1065. So we get through majority of tax season, April comes, and we have entrepreneurs that are partners come to file their return, and then they get the bad news, this return is actually late. With it being late, partnerships generally aren't going to be taxed at the federal level with the IRS, but you can get hit with late filing penalties. These can be $210 for every partner for each month that is late. So just not understanding what your filing obligation is when the tax return is due can quickly add penalties and fees to your business venture. So number two was not understanding the tax filing obligations. With that, people will often say, well, I didn't make too much money, or I made less money in my business this first year than I do on my 9 to 5 or on my previous 9 to 5, which leads me to mistake number three, not making estimated tax payments. So this is geared more specifically towards my single member LLCs, sole proprietors, which, just for the record, in the eyes of the IRS, if you have a single member LLC, you are still a sole proprietor. An LLC is actually a state structure that the IRS doesn't even recognize if you are a single member LLC, which takes me back to mistake number one, thinking they don't have a business if they don't have an LLC. You want to make sure you get your information about what you can write off from a reputable tax professional, not from LLC Twitter. But back to number three, not making estimated tax payments. So if you've ever worked a W-2 job, I want you to go back with me and think about each time you got paid and you looked at that check stub and you were like, where is all my money going to? Well, when you work for somebody else, it is their responsibility to withhold taxes from your paycheck and make those payments for you. Now, when you become self employed, ta-da, you have the privilege of doing that yourself. So what the IRS requires is that you make quarterly estimated tax payments. Now, I tell my clients that are transitioning from having a W-2 job, you know, if you are used to having taxes withheld from a paycheck every other week, it is actually going to work in your favor to go ahead and withhold money when you get paid in your business, whether that's every other week, once a month, because when you first start making estimated tax payments and that first quarter comes by and you see how much money that's going to be, it hurts. Um, it hurts my little feelings to make estimated tax payments. So mentally, to make them in smaller chunks, like I said, whether that be every other week or monthly, you are allowed to do that because guess what? The IRS is not going to turn down your money. You're not going to get a letter that says, oh no, we don't want any more money from you. They will allow you to make estimated payments as many times as you would like, but the requirement is only 4 times a year quarterly. Now, when you're self-employed, excuse me, when you are self-employed, you have to also remember that your tax payments aren't only going to be income tax, you now have something called self-employment tax. So again, if you ever worked a W-2 job, I want you to go back with me, think about that check stub or even that W-2 and look at the amounts taken out for Social Security and Medicare. Every check that you receive, it was not an option to go exempt with Social Security and Medicare. Now, it shouldn't have been an option to go exempt with income tax, but that's another issue for another show. Um, so just like when you were working for somebody else and you had to pay Social Security and Medicare, once you become self-employed, you still have to pay into Social Security and Medicare, except now it's called self-employment tax. And because now the IRS sees you as employee and employer, another ta-da, you get the privilege of paying both halves. So what do I mean by that? If you're thinking about your W-2 and how much money was withheld, like I mentioned, it was roughly 7.65%. What you don't see on that W-2 or check stub is that your employer is contributing the same amount on your behalf for Social Security and Medicare. So now that you're self-employed, that's what I was referring to as both halves. So your self-employment tax is going to be roughly 15.3% of your net profit. So again, your net profit is going to be what you made in sales minus any expenses. So if you were looking at, let's say you're a business owner and you had a business in 2020, your net profit is going to be found on line 31 of your Schedule C. So when we look at that and do the 15.3%, like I mentioned about estimated tax payments, if you had a nice profit, you might grab your chest and just be like, ouch, I have to pay all that in taxes. Well, yes, congratulations. That means you had a nice profit in your business. Now, on the flip side of that, you do get to deduct half of the estimated tax payments. But just like anything else that you are deducting, you have to actually pay it first. So when you're making your estimated tax payments, you want to figure in what your estimated self-employment tax is going to be for that quarter, as well as your estimated income tax. So failure to make these estimated tax payments is going to result in you having a balance at the end of the year. And I've talked to taxpayers and they say, you know, we just prefer to pay it at the end of the year. Two things that I hate paying. I hate paying penalties, and I hate paying interest. If you wait until the end of the year to pay your tax bill, you are also paying an underpayment penalty. Just it's not worth it. Just make those payments throughout the year. Like I said, the IRS requires them to be made quarterly, but you are allowed to make them monthly or even every other week if you would like to. You can make those online at irs.gov by going to payments and then selecting the tax year you want to apply to, or you can make the payments by check with a payment voucher. So mistake number 4, we talked about estimated tax payments in the previous one. You want to make sure that you file the return on time. I know being a business owner, nobody goes into business to do taxes or accounting, unless you're a tax professional or accountant, right? So having all the information for your taxes and your accounting can be overwhelming. You want to make sure that you get started with gathering your documents early in the year. So we're already past January. April 18th is going to be here before we know it. That is the individual filing deadline for this year, here in 2022. You want to make sure you get your documents together and that you're not in a rush so that you're not overwhelmed and you can get that filed on time. A huge thing that people don't understand is when you don't file your return on time and you owe a balance, not only are you going to get the underpayment penalty and failure to pay penalty, they're also going to tack on what's called the failure to file penalty. This penalty can be up to 25% of your tax bill. And I'll explain. I had a client who they came in and they were one of the people that said, I want to just pay this at the end of the year. Well, they ended up not only missing the April deadline, they filed their return 5 months late. Then, in addition to it being late, they end up having a $30,000 tax bill, which, they had the money to go ahead and knock that out. But because they filed it late, there's also a failure to file penalty of over $8,000, which again, very unnecessary. So you want to make sure you get the estimated tax payments in so you don't have a bill at the end of the year. Then also make sure you get it filed on time so you don't have more unnecessary penalties to pay along with the taxes, because nobody likes to pay taxes in the first place. So we don't want to add interest or penalties to that either. So we've had thinking they don't have a business if they don't have an LLC. That's the first common mistake. Number 2 is not understanding the tax filing obligations for their entity type. Number 3, the third common mistake is not making estimated tax payments. Number 4 is not filing your tax return on time. And number 5 is price shopping for a tax professional. Now, do not get me wrong. I know everybody has to start somewhere. And as I mentioned, nobody goes into business to do taxes and accounting, but you are going to get what you pay for. Let's say that you sell a service. How much money could you make if you devoted 10 hours to selling your service? I want you to think about that and really, like, if you no distractions could spend 10 hours selling your service. Because the last time I checked, and there may be more up-to-date data now, I believe the average Schedule C takes 10 to 12 hours, and this is not for a tax professional. It takes 10 to 12 hours to prepare, including the record keeping and all of that information. So that alone, if your time is valuable, is reason enough to have a tax professional. The other reason you don't want to price shop, all tax professionals are not built the same. As Safi mentioned before, she has an area of specialization. As I mentioned, I work primarily with people that owe the IRS and can't pay in full or they're facing an audit. The tax law is so big and complex. You want to make sure that you are working with somebody that understands your industry. They're up to date on all of the changes that are taking place, and that they're not just billing you for them just kind of figuring out what they're doing in your return. For example, one industry that is very specialized that I will not even touch unless you are a resolution client and I outsource the tax preparation is trucking. Trucking is a very complex industry. Just because somebody does taxes does not mean that they can do trucker taxes. Also, price shopping for a tax professional can result in you getting somebody that is what we call a pop-up or ghost prepare. They only prepare, deal with taxes 3.5 months out of the year. You don't want to work with somebody like that, because if you do have an issue with the IRS, you can't go back to the person who helped you get your filing done throughout the year. It's better to make the investment to work with somebody that knows what they're doing. So in addition to your preparation being correct, they can also help you with tax planning, which, by the way, is a separate service. Tax preparation, tax planning do not go together unless they are in your engagement letter together. But somebody specialized in the area that you haven't price shopped for is going to be able to give you that value add with pointing out different things that you can do to reduce your tax liability, different write-offs that you may not have known that you were actually eligible for as well. So today, those are my 5. Like I said, number 1 was thinking that you don't have a business if you don't have an LLC. Number 2 was not understanding the tax filing obligations for your entity type. Number 3, not making estimated tax payments. Number 4, not filing on time. And number 5 is price shopping for a tax professional.
Excellent, excellent, Timalyn. That was great information, so true. And we've all seen it. And I'm sure, you being on the resolution side, you've seen all kind of stuff. For me, what stood out to me the most is that entity type. And if you are, in this space as a professional in tax preparer or even, bookkeeping, it's really important to double check the entity formation documents. So the articles of organization or articles of incorporation and that EIN letter from the IRS, that's going to tell you what their structure is, right? Because I had someone come to me the other day, oh yeah, I'm an LLC. And I'm like, okay, but your business name has Inc. at the end. So you're not an LLC and your EIN letter says corporate return. So you have to really check the documents, because innocently, some people just don't know. Somebody may have set it up for them and they just weren't in the loop. But that multi-member LLC versus single member LLC, big difference in filing there. And so that EIN letter is going to tell you, this is what the IRS thinks you are. So if there's a mistake, okay, let's correct it. Let's not file the wrong return and deal with notices, months later. So that's a big one. Definitely knowing what type of entity you are for your filing requirement and also your filing obligations. If you're a C Corp in IRS's eyes is different than an S Corp, is different than an LLC. So that's really important to get that right. And then the estimated taxes, right now we're in February of 2022. And so tax season is just getting kicked off, and there's going to be people who owe. And the tricky part of estimated taxes is that you find out you owe, but then by the time you find out you owe, it's time to pay for the year you're in. So, right. So for 2022, you're going to file, let's say by March, right? And you owe, but then you still have a profitable business. So for 2022, your first estimated payment is April 18th, 2022. So now you have, a situation. If you can't afford to do both, what do you do? And that's when you want to work with a professional to kind of map out the best strategy for you, because you want to get ahead of the game. You don't want to have this constant rollover effect of balances due each year. Because even if you can set up a payment plan, and I'm sure you may have seen this, Timalyn, the IRS is not going to just keep giving you payment plans year after year without correcting the problem. So you definitely want to get ahead of it. You want to, it was a great suggestion with paying the estimates in biweekly, like you normally would have, happened if you were working for somebody. Because when you're getting all that money up front, yes, you're going to have deductions to offset it, but that money looks good. And then when that tax bill comes, you're like, where'd it go? Because it's been spent all year. So that's a great suggestion of paying in weekly, paying in biweekly, paying in monthly for your estimated payment, so it's not a big hit. Definitely. And so can you share, Timalyn, any, experience you've had in a situation like that where someone, owes, and then it's, the next year is coming up and they're going to owe again, and your resolution specialty, what are some suggestions that you may give someone in that situation?
Yeah, that's a great question. Oftentimes, when people are not in the tax world, they hear all the commercials on the radio or see them on TV, the IRS forgiveness program. They think, "Oh, that's me." If you're still profitable, that's not you. That's not you.
Right.
They're not. They're not in the business of forgiving tax debt for people that are still making money. Um, the first thing that I work with them to do is we have to get a handle on these estimated tax payments. Like you said, they don't just give out payment arrangements. Especially a lot of people, when they DIY their payment plan with the IRS, they don't realize when they owe the next year, you just made that arrangement default. I've even seen, and little part of me feels bad because you don't know what you don't know. A lot of times now, the IRS will not even give you a payment arrangement or payment plan if you don't have estimated taxes set up. That will be a condition. And you have to keep up with the estimated tax payments because they don't want you to keep rolling over. Now, if it's this time of year, of course, they'll be a little more flexible because, of course, when you get ready to file, you're probably going to owe again. But you have to make sure that you communicate with the IRS to let them know, like, hey, we're correcting the mistake. Don't default me. Can we add this on here? But the first thing is we have to get a handle on the estimated tax payments to make sure that this does not keep happening again.
Definitely. That's really important. Sorry, my son is texting me.
No, you're fine.
um, it's definitely important to get a handle of it, and business owners don't account for that. So what you want to do when you're making money all month long, if you can't make those payments, which I do recommend, and you should be able to, but at least put aside money, so 30%, 40% in some cases, between federal income tax, state income tax, and estimated self-employment tax, depending on your business structure. These are three different taxes that you may have to pay in. And in some cases, depending on where you live, it could be 40, 50%. Now, there's other strategies for tax planning that can help lower that. But at the end of the day, you want to be carving out at minimum. I always go with 30% just as a safe harbor to put aside in another account somewhere that you can't touch, so that when those quarterly dates come around, that you're ready for them. Now, if you're an S corporation, for tax purposes, the benefit there is that you will have yourself on payroll. That's a requirement, and you will be paying yourself a reasonable wage. But you're probably going to have profit left over in the company after that. Let's say you've met your reasonable wage threshold and you're still profitable. That money is still coming through, passing through to you. Yes, it's going to avoid self-employment tax, but it's still going to be subject to income tax, both federal and state. So that may be a situation where you still have estimated payments, or you need to increase your withholding through your paycheck to cover the extra profit. So this can apply in all businesses. Even if you're a C Corp, the company itself is going to have estimated payments, if it's profitable. So estimated payments are not going anywhere, so might as well get used to it and figure out the best way to make it work for you. And, we're business owners. We know, how difficult it can be. Like you said, Timalyn, it hurts every time you make the payment. So we can feel your pain, but at the end of the day, it's less pain than dealing with the IRS being in trouble.
Yes.
Absolutely. So Timalyn, share a little bit about how you got started in your practice and getting into the tax resolution specialty. And if anyone has a question, we are open for Q&A. So we'll be on another few minutes. But if anyone has a question, feel free to raise your hand if you're in Clubhouse here, or drop it in the chat. But go ahead, Timberland.
Yeah, so I was one of those people that went to college and knew that I wanted to do accounting. I had this one track mind what I was going to do. Then I took my first tax course in college and I was like, I don't know, I'll try it out. Well, I had the opportunity to take a semester off from school and do a full-time internship. And it was like, oh my goodness, I love this. I work for a CPA firm, so I did have hands-on experience right out of the gate with partnerships, corporations, S corps, and I just love the tax law. So I always tell people within the business school, they kind of look at the accountant side eye, like you guys are nerds. But then within the accounting school, it's like, oh, you tax nerds. And I was like, dang it, I'm a tax nerd. So I did 3 busy seasons with them. Then after that, I I got engaged, graduated college, and then at the very end of the year, December snuck my daughter in, so I had a crazy year. Um, and Louisville is bigger than where I'm originally from. So talking with my husband, I really didn't want to put my child in daycare. Um, I was privileged. I got to stay with my grandparents. I was like, oh, I can't do that. And so I stayed at home. And while I stayed at home, because I graduated from a pretty prominent business school in the area, I was able to continue working and picking up contract work because classmates were picking up businesses or creating businesses. But one of the things that caught my eye when I was at the CPA firm, we did higher level tax planning and that type of thing, but we didn't represent tax clients. So it was more the everyday people that had IRS problems where I was kind of like, well, all you have to do. And then I kind of realized like, oh, that's not everybody's reality. Everybody doesn't love doing this or looking at tax law. So when I went out on my own and had my daughter doing the contract work, and I built that book of business up, that is one of the things I looked at. I knew that I wanted to be that advocate to represent taxpayers that didn't even want to open their tax notices. You probably have experienced that too. Sometimes I have people with a stack of unopened IRS letters. And I'm like, what's going on here? So that's how I got into the tax representation piece. And when I left the CPA firm, nothing wrong with that license. You're a CPA. But I knew that for me at that time, I didn't want to go into any other specialization. The EA license was the one I saw, the 3-part test and focus all on taxes. I was like, I'm going to get this so that I can step in, fill in that gap for taxpayers with the IRS. Nobody should be losing sleep over back taxes.
I totally agree. And you don't want to go it alone, you know, the saying I always bring up is that, yes, you can go to court without a lawyer, but does it make sense? And dealing with the IRS, I feel the same way. It's just some reps are nice, don't get me wrong, some are aggressive. And when they know that you don't know, so they want to collect at the end of the day, right? And you have rights. And so sometimes you don't know those rights if you're not working with a professional. So definitely take those suggestions that Timalyn gave so that you can stay out of trouble with from dealing with the IRS or the state. States could be even more aggressive. New York being one of them. Right. So stay out of trouble, do those suggestions that Timalyn gave. Those top 5 suggestions were great. And if you do get into trouble, you can definitely connect with Timalyn. So we're going to go ahead and close out. I'm not seeing any questions just now. So I'm going to give my background in case anyone joined late. Then Timalyn, I'd love for you to share your background as well as contact information. So once again, we were here for Business Basics Friday, discussing the topic of 5 common tax mistakes that entrepreneurs make. I'm Safietou Russell, CPA and enrolled agent, founder and CEO of SDR Consulting Inc. And we're based in New York. We have a virtual practice, so we work with clients all over, and we mostly work with startups as well as businesses who need cleanup. So we, do consultations as far as entity selection, bookkeeping setup, tax prep, tax planning as you grow, and then as far as cleanup services that would entail doing a compliance check, see what returns are missing, bookkeeping cleanup if you're years behind, and back tax filing. And then lastly, if you are into trouble with the IRS estate, we can assist with some tax resolution cases. If not, we'll contact Timalyn, right? And we can be found online at sdrconsultinginc.com, on social media at SDR Consulting, and by phone 516-255-6603. So Timalyn, go ahead and share your information.
So my name is Timalyn Bowens. I'm also an enrolled agent. I am the owner of Bowens Tax Solutions here in Louisville, Kentucky. Even though we are in Louisville, Kentucky, we can represent taxpayers in all 50 states. We focus primarily on IRS issues. We do some tax preparation, tax planning, but that's usually a result of fixing the tax problem because you don't want to have that issue again. You can connect with us on social media. On Instagram, it is Bowens Tax Solutions, and it's the same on Facebook. And then also on the website, which is www.bowenstaxsolutions. I tell people we have more than one, so add the S, bowenstaxsolutions.com. I do also have a blog, Tax Tips with Timalyn. So just in case, there will be other stuff that comes along the road of entrepreneurship. I do cover other tax topics there as well.
Perfect. All right, Timalyn. So thanks again for your time today. It's definitely been a pleasure. Join us next week, every Friday at 12 o'clock Eastern Time for Business Basics Friday to find out what the next guest speaker's topic is. And also, if you're listening to this on the podcast or through Clubhouse, you can find the video on YouTube as well as Facebook page for SDR Consulting Inc. So everyone have a great Friday. Stay safe out there and enjoy your day. Thank you. Bye-bye.